After the call on Yahoo Finance starts right now. Brad Smith here alongside the pro the illustrious Shauna Smith. And Shauna, we just got off the Disney earnings call. We've been tracking shares in after-hours trading of Disney throughout the call, which has had no shortage of information fireworks. Here was one of those big moments that we have to play for our viewers that had the stock jumping.
In general, the savings will come from reductions in SG&A and other operating costs across the company. To help achieve this, we will be reducing our workforce by approximately 7,000 jobs. While this is necessary to address the challenges we're facing today, I do not make this decision lightly.
Okay, so our viewers heard there, and my goodness, Shauna, on the call, we heard serious business Bob. There's no easy way to go out on an earnings call and announce a massive restructuring, slash headcount by 7,000, and allude to the very asks that we had heard from one activist investor in Nelson Peltz. You got all of that in this earnings call, Shauna.
You do, and I think the street is very happy with what they heard from CEO Bob Iger. You can see that in the after-hours action here with the stock. But when you take into account some of the changes that were announced, the reorganization structure, the fact that it's going to be broken down into 3 different divisions, we've got entertainment, parks, ESPN. I think that brings up the question about what exactly Disney is going to look like, not today, not tomorrow, but really 3 to 5, 10 years from now, because we know one of their core businesses, streaming, linear TV, obviously huge here. Company, that landscape is significantly changing, has significantly changed. Iger talked about that a couple of times on this earnings call, saying streaming is important for the future. This is how we are adjusting. And at least from the initial reaction right now, the street is very happy with Iger's first return on the earnings call.
Yeah, that's right. We had taken a look at shares here. We've got this pulled up on our Yahoo Finance, the Wi-Fi Interactive. And just for kind of a metric, or at least a level check here, we had seen shares immediately after the report, before the call. They were up by about 2%, a little bit more than that. They were as high as 8% higher in a move once the earnings call began. And once they got to that pivotal moment where they began laying out what that restructuring would look like, some of the cost-cutting measures, what the pathway to profitability for Disney Plus by the end of 2024 would look like, and then even the reinstatement of the dividend by the end of the calendar year as well. So all of these factors considered, you saw stock move in an extreme reaction to everything that we heard here. And I know there was another clip that you had flagged as well for our team that we wanted to give to our viewers too.
Yeah, there certainly is, Brad. When we're talking about streaming, the future there, we heard a couple of comments from obviously Bob Iger, but also from CFO Christine McCarthy. And she was talking about what they are seeing now from Disney Plus, also what she expects to see from the ad tier division. So let's take a listen to that.
The Disney Plus domestic price increase has been playing out as expected, with only modestly higher churn, which may also negatively impact the fiscal second quarter given the timing of the December price increase. That impact, in addition to slower than previously expected growth in some international markets, suggests core Disney Plus subs may grow only modestly in Q2.
That modest growth there, I think that's one thing that maybe the street wasn't initially too pleased with. We saw some of the after-hours gains pull back just a bit after we got a little bit more clarity, a little bit more information when it comes to their Disney Plus division and the growth that we may or may not see over the next couple of quarters. It is interesting to know, and I want to point out to some of the losses that we are expected to see. Disney saying that they do expect DTC losses to improve by about $200 million in that second quarter. And when you take a look at the Disney subscriber numbers for the last quarter that we just got, it was the first drop that we've seen in Disney Plus subscribers here, dropping by about 2.4 million. So this is a concern for the company. They're saying that the ad tier, that growth there might not happen until the end of the year. But certainly, I think that was one thing that maybe the street wasn't too excited about in this earnings call.
All right, we got to get to our vibe checks here. And Shauna, I want to know what vibe you're giving this call after listening to this. I mean, this is exactly what we ask for in an earnings call. We ask for the fireworks like this, the transparency, but I got to know what your take on it is.
It is exactly what we asked for. This was a much more exciting earnings call than you can really compare to most of the ones that have taken place. We've had 70% of the S&P already reporting, and this was one of the most exciting, if not the most exciting so far this earnings season. But my vibe is it's good. It's really, really good for Disney, for investors, for shareholders. Obviously not good for some employees of the company, the fact that they are cutting 7,000 jobs, but they did need to pivot. They did need to adjust. They did need to change their strategy going forward. Like you said, this is exactly what the street wanted to hear. And we're seeing that reflected in the stock after hours. And I think also just in terms of the next couple of quarters as they do adjust their business, thumbs up from me. What about you?
I'm in the same camp as you, honestly. And this is one of the best grades that I've given to an earnings call thus far and after the call. And I'll lay out the reasons why. But I essentially gave this a good rating. If we're going by numbers, I gave it an 8 out of 10. But here's why. This was an incredibly tough task. And Bob Iger started off the call basically saying to not just the rest of the executive team, but to the street and investors that, look, my track record for transformation, it speaks for itself. He ran through all of the big deals that he's made in the past. Of course, the transformations that they've had to lead companies through previous recessions. That's where you started to get the inkling that they were really going to deliver some material changes that can change the course of how some of the investors evaluate this business, but also how they intend to improve margin and returns. Also, increasing that accountability across this new reporting structure, something that's extremely critical to the business here in order to hit some of those profitability goals. And ultimately, they are reassessing all markets. They even acknowledge that they may have gotten the pricing strategy wrong on the streaming side of the business too, which I think was a huge acknowledgement here. So I gave it an 8 out of 10. It was transparency. It was ripping the Band-Aid off. And as tough as it is to hear about some of the layoffs that we've continued to hear about over the course of earnings, let's also remember that for this company, we had seen them add on to that figure year over year. And so now this is kind of a resetting or normalization versus, I believe, the 2020 level of where that headcount was at. So that's something to kind of keep in context here too. But for a business that's vastly different from when Bob Iger left it, but we'll see how his reset starts to take place over there at Disney.
Yeah, and he is not wasting any time. So we've talked about Wall Street's reaction to this earnings call. Let's talk about Main Street's reaction. Ali Canal, who covers the company here at Yahoo Finance for us, taking a look at that on social media, across social media. Ali, what did you find?
Oh gosh, guys, there's a lot of reaction to this earnings report, but let's focus in on those layoff announcements. 7,000 workers will be cut in an effort to slash $5.5 billion worth of cost. I have this tweet here from a user, Cat Von Kitten 1, in response to these layoffs, who wrote, quote, "Too bad they will be the ones that actually were out in the trenches working and not the ones sitting in the ivory tower." And this is an interesting point, considering the backlash Disney has received when it comes to executive compensation. We have current Disney CEO Bob Iger, a salary of about $27 million a year. Then the former Bob Chapek, he was ousted, paid $24.2 million in 2022. And guess what his severance payment was? More than $20 million. And then it's not just a C-suite, because we had Jeff Morrell. You guys remember that? The head of corporate affairs received a whopping $3.4 million a month for just a 3-month stint at the company. That's $150,000 per day. So it's these executives making these boatloads of money. And on top of that, we have Disney service workers rejecting a plan to hike pay by $1 an hour. That's in the background of all of this. So it's this reality that you're laying off 7,000 workers, but still spending aggressively in other areas, especially on those salaries of those higher level executives.
Yeah, we heard a little bit more about what they're doing in the succession plan. Much of that had already kind of been telegraphed. Mark Parker, who is going to be the executive chairman once the vote once the vote finally goes through, he's going to be leading that succession committee. I mean, is it clear at all who we can expect them to try to select or try to even bring up through the board in order to run this company at Disney, Ali?
I would say those that are in those big divisions. I mean, Dana Walden, Josh D'Amaro, those come to mind. I mean, if you think about...
Chapek didn't work last time. Chapek
That
didn't
is
work
true.
out.
Chapek didn't work last time, and that was a big thorn in Iger's side. And I think whoever it is, it's going to be very carefully selected, very highly debated, because you can't have the same thing that happened with Iger happen with Chapek. But analysts have told me too, it's almost as catch-22, because a lot of these executives that do come in to succeed Bob Iger, they might be looking over their shoulder being like, is Iger really gone, or is it going to come back? And listen, after this earnings call, I get it. I get why Wall Street loves him. I get why analysts love him. He's a straight shooter. He tells it to you like it is, and it makes it very easy for the investor to make decisions.
Yeah, it does make it very easy for the investor to make decisions, right? We talked about the layoffs. Ellie, I know you have a couple more tweets for us. What's next?
So another tweet is by Robert. He says, quote, I feel Disney is going to announce a password sharing crackdown real soon. Now, obviously, this is alluding to Netflix, and it's a very controversial move to curb password sharing. But I like this tweet because it's the perfect representation of what's happening in media right now, right? All of these companies prioritizing profitability. They're making money over subscribers. Another example of that is Bob Iger saying on this call that there will be no more long-term subscriber guidance. That's something that we've also heard from Netflix. They are not going to be providing that moving forward. And on the profitability side, Iger did say that Disney Plus will achieve profitability by the end of fiscal 2024. And he seems pretty staunch in hitting that target. But I mean, you have password sharing crackdowns from Netflix. You have Disney cutting 7,000 employees, looking to slash 5.5 billion of costs. This is something that's happening across the sector.
Yeah, I don't know. From the backlash, though, that we heard from Netflix, you would think Disney might think twice before implementing something very similar. I mean, it hasn't even come to the U.S. yet, and people are up in arms already.
Oh, I know. And I have received emails about this. I'm like the Netflix therapist. I said this on the show before. People are so concerned about this. And you have to think that the competitors are watching Netflix really closely, but everyone's trying to strategize right now what their next move is.
Wow. All right. This has been awesome. Allie, if we got one more tweet, just very quickly here, I know we got to go.
Right, real quick. One user writing, how about you stop jacking the price up, Bob? And this one is focused on pricing. And Brad, I know you alluded to this. Iger admitting that there were elements of pricing that he got wrong. He said, quote, some initiatives were alienating to consumers. And that takes a lot for a CEO of a major company like Disney to admit. Of course, a lot of that was related to the Chapek era. And we know that Iger and Chapek don't quite get along. Iger was very, very clear that he was fine calling out Chapek's policies. He said that, you know, the former structure severed that link to creativity and it must be corrected. But I just think Iger made it very, very clear that he's going to really take a hard look at the park pricing, at the streaming pricing, and adjust need be in order to more appeal to the consumers.
All right, Alec, we got to cut you loose. Thanks so much for breaking this all down, tracking what the chatter on the street has been, and we'll see if Iger and the team listen to some of those pricing concerns from consumers. Shauna, before we wrap, got to get your final take here.
Final take, this was a very, very strong earnings call from Iger, from McCarthy. I think the focus moving forward when we talk about the roadmap for Disney, it's going to be traditional TV business and streaming, what exactly that looks like, because the company is saying that they do see $1 billion less in operating income in that division during the second quarter, ESPN accounting for half of that. But Iger, once again, reiterating the fact that, quote, eyes are wide open when it comes to the slowing that we're seeing in the linear business, the sports costs. We didn't even have time to get into that, but just in terms of what they are spending, it sounded like they were pretty optimistic about NBA rights going forward, but it's all about streaming. It's all about straddling that line with traditional TV business and what that will look like for Disney here on out.
They answered three key questions for me here today, and one of them was on ESPN. They are not considering a spinoff. Number two, they are considering potential content licensing. And number three was the restructuring that we anticipated in some of those cost reductions. I think they really did, and I hate to keep using this, but they did thread the needle at the end of the day, and they answered a lot of key questions that the street did have. And so that's why we gave them the tapes that we did and the vibe checks that we did earlier on.
Yeah, and Brad, real quick, we haven't even talked about the parks. The fact that they're seeing such strong demand in the midst of a looming recession, maybe we're already in a recession, people are facing higher prices in almost every aspect of their life, yet people are still taking their trips to Disney. That is just incredible.
All right, we've heard some of the executives within the travel, leisure, the experience economy space say that we're entering into a golden age of travel. We'll see what that means for Disney going forward in the future. That's it for us here on Yahoo Finance. You've been watching After the Call. Brad Smith here with Shauna Smith, breaking down all things Disney and the magic or the tragic. Well, it's been mostly magic on the call here today, we'll say. Thanks.